Hello, and welcome to the Semiconductor Industry Association's public webinar series, where we discuss topics that affect the semiconductor industry. Today, we will review the industry in 2021 and discuss the outlook for the industry in 2022. I'm Robert Casanova, Director of Industry Statistics and Economic Policy here at SIA, and I will be your moderator for today's webinar. And it is my pleasure to introduce today's panelists. Our first panelist is Andrea Lati, who is the Vice President of Market Research at VLSI Research. At VLSI, Andrea focuses on managing and developing forecasting models, as well as providing analysis and research on the electronics, semiconductor, and equipment markets. Our second panelist is Dale Ford, who is the Chief Analyst at the Electronic Components Industry Association. At ECIA, Dale provides expertise in technology trends, competitive analysis, forecasting, and supply and demand research of the electronics, semiconductor, and electronics components industries. And finally, John Pitzer is a managing director at Credit Suisse, where he is a global technology strategist, technology sector head, and semiconductor analyst. Now, before we get to the first panelist, I wanted to briefly go over the industry's performance for 2021 as a primer for the panelists. Despite the continued high demand for semiconductors in 2021, it was actually a record year in terms of sales and unit sales for the industry. Sales reached over $500 billion or $556 billion last year, while unit sales reached an unprecedented 1.15 trillion shipments. The increase in sales specifically was 26% higher in 2021 than in 2020. And to give you an idea of the magnitude of this increase, the percentage increase from 2019 to 2020 was 6.5%. It is also worth mentioning that the increase of unit sales reflects the industry's continued efforts to meet the high demand across all sectors through an increase in fab utilization, which has been running for well over 90% throughout 2021. In addition to the record sales and unit sales, shipments to the Americas saw a 27% increase over the previous year, which was the highest percent increase across all regions. As far as the specific product types, analog devices, now these are devices that are used in cars and computers and other consumer electronics, increased by 33% to $74 billion in 2021. So with that information in mind, I'd like to pass it along to Andrea for the first presentation.
Do you see my presentation, everybody?
Yes.
All right. All right. Hi, everyone. And it's a pleasure to be back and present here for SIA. Today, I'll give an overview of the semiconductor market, look at some of the pressure points that we're seeing there, and also see how the year is shaping out for the semiconductor industry. So if we start with the ICs, this chart here shows the weekly IC sales. The orange line here is the 2022 weekly IC sales. And as you can see, actually, we're off to a great start. IC sales are tracking well above last year's levels. And again, 2021, as Robert said, was a very strong year for the semiconductor industry, with sales growing over 25%. So given the momentum that we're seeing in the first quarter, things are looking pretty good for the semiconductor industry. The weekly IC sales are running at about $10 to $12 billion on a weekly basis. And more importantly, what we've seen in the last few weeks is that the gap between 22 and 21 has widened in the last few weeks. So again, the momentum is still carrying on into the first quarter of this year. If we look at the IC sales in terms of year-over-year growth, you'll see that the growth actually peaked in July of last year at about 33%. And that's kind of interesting because the previous peak during the memory bubble in 2018 happened at about 34%. And since July, actually, we did see the growth roll over. However, it's still holding up at a very, very high level. We're currently at about 33-34% year-over-year growth on yearly basis. So again, we're at a very, very high levels if we look at basically how industry is performing on year-over-year basis. One of the most frequent questions that we get these days is whether the IC industry is overheating given the high growth rate that we have been seeing over the past year. The orange line in this chart here shows the weekly IC sales started since 2008. And the gray line is the polynomial trend line of the IC sales. And as you can see in this chart here, the industry has gone through several cycles, and every time that we've deviated from the trend line, a correction on the upside or the downside has occurred. And if you look at more recently, the IC sales have been pulling away from the trend line since April of 2021. So if we look in terms of the time frame, we've been actually above this trend for about a year now. And we did see a little bit of a dip early in the year, but again, it's bouncing back again and we're pulling away from the trend again. And if we look at in terms of the historical averages, an upcycle is usually between 2 to 3 years. So from that perspective, right, we're only 1 year into the cycle based on this chart. We still have some runway left as far as the cycle, historical cycles are concerned. If we look at some of the major semiconductor segments, you will see that, you know, growth was very strong last year for pretty much all the segments. Of course, auto had a huge year given the shortages that we saw in the industry, but pretty much all the segments grew at the 25 to 30% growth rate throughout 2021. What we're seeing actually right now is really a rollover, especially for the high flyers last year, primarily auto and analog and power, and they are moving more into this 30% growth range. However, if you look at the logic segment, it's maintaining its momentum quite nicely, actually, and also the DRAM market is also holding up quite well, even though it's growing at 40% plus on year-over-year basis. So one thing that, you know, we kind of can take out of this chart is that we are seeing the growth rollover, especially in the automotive market, even though we do believe that, you know, shortages are abating there. They are still there, right? They are still impacting the market, and we do think that they are going to be probably having an impact even in 2022. So if we look at the supply and demand heat map, you will see that pretty much we're still in a very tight business environment. DRAM has actually moved from tight to shortage. NAND and IDMs are into tight environment. In Foundry area, actually, we've seen a little bit of looseness there, but that's mainly seasonal. But overall, again, we're dealing with a very tight environment as we start the year. IC inventories are rising, but we believe that the supply is still tight. If we look at the total inventories, which is a teal line, they are growing about 25% on year-over-year basis. The inventory to billings ratio, which is this red line, actually is trending lower because IC sales are still growing at a faster clip than inventories. The one thing that I worry here is that, you know, when the IC sales do roll over to a more, let's call it normal growth rate, perhaps in the high single-digit level, the inventories could become a problem if they continue to stay at this 25% growth rate clip that we're seeing right now, and they could become actually a headwind for the industry. However, we do expect the inventories to remain elevated in 2022. And part of it is because, you know, companies have shifted their philosophy in inventory management from just in time to just in case. We do expect more inventory accumulation, especially in the automotive, industrial, and networking infrastructure. And part of this is because if you look at the inventories there as percent of total of bill of materials, it accounts for a very small part of that. And also the obsolescence rate in those markets is very low. So we do expect more restocking in those markets to continue throughout 2022 and actually become a driver for sales, especially in the automotive and industrial segments. The Chip Price Performance Index, or CPPI, is one of our most reliable leading indicators that measures chip prices relative to performance and functionality. It's basically a health measure of the industry. So when the CPPI, which is a blue line, declines at a faster rate than the Moore's law, it basically indicates that there is, oversupply in the market. It actually indicates weak market fundamentals ahead. Back in 2018, when the semiconductor market was still growing and actually had a very good year, we did see the CPPI begin to pretty much crash. And for us, it was a warning sign about 2019, which turned out to be a pretty tough year for the industry. And then back in 2019, in the second half, we did see the CPPI improve and start to increase. And for us, it was a sign that the market actually was entering a recovery phase. And of course, 2020 turned out to be a pretty good year for the industry. Last year, we did see the CPPI roll over a little bit, especially in the first and second quarter. But as of the third quarter, we did see the trend reverse and actually trend higher. So all this is telling us is that we expect the next 6 to 8 months to be very, very strong for the industry. And this is one of the reasons why we feel very bullish about the industry prospects in 2020. Speaking of prospects, we believe that the industry is going to grow about, semiconductors are going to grow about 14% this year. ICs will grow a little bit faster at about 15%. And if you look at the fastest growing areas for this year, we believe will be automotive, analog, and power. But as you can see here in this table, we expect very, very strong growth across the board for all the major IC segments. If I shift a little bit gears and talk a little bit about Capex, you'll see that there has been a lot of spending happening in the last 3 years in the industry. Last year, Capex increased 37% to about $148 billion. And this year, we expect Capex to hit $182 billion, up 23% from 2021. And as you can see in this table here, the Capex has become very top heavy. The top 6 companies account for more than 75% of spending. This year, we expect that share to remain pretty much the same. One interesting thing that has happened in the mix here is that the China's share actually has declined over the last 2 years. The top 5 Chinese companies that are listed here accounted for 9% of spending last year, which was down from 13% back in 2020. This year, actually, we see the China's shares to basically account for about 8%. So again, we expect another slight decline actually in their share. And that's mainly because the top 6 companies are pretty much outspending everybody, in the market. And if we look at their spending plans, especially in the logic side and foundry side, it's really off the charts. We're looking at about over $120 billion in investments in the next 2 years. And as you can see in this table here, it's primarily happening in the foundry and advanced logic space. So basically, we have Intel, TSMC, and Samsung spending tens of billions of dollars in new projects across the world, essentially. And of course, this big surge that we've seen in the foundry and advanced logic has led to a shift in mix in spending, and in particular in the capital intensity from memory to advanced logic. So we basically have gone from that big spending ramp that we saw back in 2018 for the 3D NAND conversion to essentially EUV in 21 and 22. And if you look at this, the Capex shares, we've seen a significant shift here. Back in 2018, memory accounted for 53% of spending, and advanced logic and foundry accounted for 35% of spending. This year, we expect a complete reversal on these ratios. We expect foundry and advanced logic to account for about 56% of spending, while memory to account for only 33% of spending. So of course, this has created quite a bit of change also in the equipment spending patterns, but it is a very interesting trend that has happened over the last 5 years. So if we look at the advanced logic and foundry spending, Capex there increased 45% to about $78 billion. Since bottoming in 2018, Capex in those segments actually has increased by almost 2.5x, so tremendous growth there. This year, we expect another strong increase in Capex as well, with the overall Capex increasing about 32%, again, driven by the usual suspects like TSMC, Intel, and Global Foundries and Samsung. One thing that has people worried with the advanced logic and foundry segments is really the capital intensity, which again, has been increasing substantially since 2018. We're approaching 40%, which clearly this is not a sustainable level, you know, in the long run. But we do think that it's going to be elevated for the next few years, given the spending announcements that the companies have announced. But of course, this has also raised concerns of overcapacity being built into those markets. If you look at the memory side, actually in the memory side, the Capex has been going up since 2019. Last year, it was up about 22%. However, it was still below the peak that we saw back in 2018. We do expect the memory spending to increase about 9% this year to about $61 billion, and finally surpass the 2018. However, if we look at the capital intensity rates there, they've been actually declining. So the spending levels there have actually been quite conservative, and the overall fundamentals look very healthy, which is actually a little bit of a change because memory has always been sort of the more volatile and more difficult market to manage. But this time around, it seems that spending levels are very healthy and the overall market fundamentals there are very, very sound as we roll into 2022. And of course, the thing that we keep getting asked is really how affordable is all this spending that we're seeing, especially at the leading edge. So what I did in here is really put together a chart of the capital intensity for the top 6 companies, since again, they account for over 75% of spending, and look at also the operating profit. And if you put a trend line in the capital intensity, you'll see that definitely it has been increasing since 2003, and it's hitting an all-time high now since then. And but on the other hand, the operating profit has also been increasing. If you look at the trend line of the operating profits, it's actually in the lockstep with capital intensity. So even though the industry is spending more money in capital equipment and Capex, they are also increasing their profitability. So again, it has been a win-win situation for the industry. So in summary, we expect 22 to be another great year for the industry. As I said, we expect IC sales to grow over 15% this year, which is a very impressive number considering the almost 27% growth that we did last year. With units, we're expecting another double-digit growth rate for this year. And equipment, again, another big year with sales growing about 20%, and overall electronic sale growing about 7% for 2022. So this is my presentation, and I'll hand it over to, I believe, John.
Thanks, Andrea, for that great presentation. We're going to pass it along to Dale now to give his presentation. So take it away, Dale.
All right. Oops, let's say that. Okay, let me just get this up to. There we go. All right, great. Well, thank you. I appreciate the opportunity to share some of my thoughts and analysis here in covering the electronics industry. Here, I'm going to go through, take a look historically, looking forward a bit, look at supply chain issues, and then I think a critical issue that cannot be ignored in today's environment, address the issue of inflation. So we cover more than semiconductors in our research at SIA. We cover all electronics component categories, including passives, connectors, electromechanical components primarily. And charting the growth, this chart shows up through the third quarter of 2021. We still don't quite have the worldwide data for the passives categories, even though semiconductor data is there. But in spite of that, the trends we saw through the third quarter are very interesting. Yes, we had a very strong growth period for semiconductors. Interestingly enough, capacitors and inductors actually surpassed semiconductors in terms of their growth during 2021. And again, this is through Q3, but the trends continued through the fourth quarter as far as I can see. And we see a similar picture in growth, both between Americas and worldwide. If we, come on, there we go. As has been shown, this is charting the WSTS data. As was noted, we saw a significant surge in growth. The interesting thing was, as we came to the third quarter last year, the question started to become, have we hit a peak and we're going to start coming down the backside of the cycle? And it's interesting, through December, when we hit December, we saw a sudden surge at the end of the year, which was quite interesting. So while that might have been an indicator that we were going to start moving towards the back half of the cycle, that end of year surge seems to indicate that this current cycle has more legs associated with it than what might typically be expected. So it's not unusual to have a bit of volatility as we reach a peak in the industry, but it is something that we'll have to continue to keep an eye on as we move forward. This surge was particularly noted in the memory space, but it wasn't just in memory components where we saw this quarter-over-quarter growth. It took place in the non-memory categories as well. So it was a broad-based type of result that we saw. Looking at the cycles, and again, I've shared this chart before, but for those who haven't seen it, I've taken all of the semiconductor cycles that the semiconductor industry has experienced. I've normalized them all to start their growth from when they started up. So that's all normalized to 0. And then we start the start of each cycle at the same point in time in month 1. And the current cycle is shown in the heavy black line. Now, in the early days of the semiconductor industry, and as we recovered from the Y2K decline, we saw some extremely high growth rates that you could build off of a relatively small revenue base. But if you look at the more recent cycles, this current cycle is a very strong, robust cycle. This is showing the annualized growth here. So in terms of recent growth cycles, this is one of the strongest cycles we've seen in growth in the recent history of the industry. And the way it's trending, while most cycles would typically last about 4 years, this cycle, unless we hit a discontinuity, which I'll come back to, which is certainly possible, this cycle appears to have momentum that could carry it beyond the average 4-year cycle. So looking forward, these are the forecasts published by WSTS. And while the 2021 results and the forecast they put out in fall surged notably well above what had been forecast before, looking out in time, they came back very closely aligned with their prior forecast for the 2022 and beyond. And I have a lot of respect for the work done by WSTS in developing these forecasts. It's very much a bottoms-up driven view with a lot of expertise and visibility going into this. But I do believe that the early indicators that I see that 2022 can outperform significantly this forecast that was published in the fall by WSTS. One of the areas we look at for all electronics components in the end markets in our survey that we do at ECIA, we do an electronic component sales trend survey, both on a monthly basis and on a quarterly basis. And we ask participants to share their assessment of sales compared to the prior month. And I take this, put it into an index where 100 indicates a flat. Anything below 100 would indicate expectations for declining sales. Anything above indicates expectations for growth in sales. And we see that February really saw a surge in how people see sales taking place compared to January. So you had a typical seasonal slowdown towards the end of the year in all of the categories, but then we see a significant surge. And while it declines a little bit off of the highs as they look forward to March, it still remains very resilient in terms of expectations of sales in all component categories looking towards March. Now, if we look at the full quarter now, if we look at the first quarter and then look even beyond into the second quarter of 2022, we see that for semiconductors, the strong growth expectations in the second quarter pull back notably. Overall expectations for growth still very strong, shown in those green bars. So the overall view is that there is growth, and it's quite consistent overall with what people are expecting for the first quarter. However, the high-end expectations pull back notably from Q1 expectations. So still growth expected, but you would say moderated growth for semiconductors as we move through the second quarter of the year, based on expectations from participants in the supply chain, manufacturers, distributors, and manufacturer representatives. This again, just looking at February and the overall market status outlook. If you look at just how do they see things as just simply better or worse, we again saw a significant improvement overall in the end market perspective in terms of expectations. Now let's look at the supply chain itself here for a few minutes. There are all kinds of supply chain disruptors that we have to take into account, and we've addressed before. But we now sit at a very difficult situation where trade wars are giving way to concerns about actual hot wars, of course. We cannot ignore what's taking place with Ukraine, with Russia, and the global implications that that has for the supply chain. And so what's taking place there has ramifications. While Ukraine and Russia, of course, are not major producers or consumers of electronics or electronics components, they do play a critical role in the energy space. And what that does to energy and the raw materials prices and the challenges that creates is very significant for our industry. So while not a direct impact, the indirect impact is that will play out around the world with financial systems, supply chains overall is very significant and cannot be ignored. We saw the lead times, thankfully, peaking, it appeared, in December and remained relatively flat for the January results in terms of lead time for all component categories, really, in semiconductors. That is a very encouraging sign after we had surged and just shattered all records in terms of lead times for semiconductors. But maybe we shouldn't get a little too far ahead of ourselves, because if we look at expectations and how it's seen by participants in the supply chain across the board, including in semiconductors, they see lead times increasing again as we move out in time. So while they appear to have peaked, the sentiment by the supply chain participants is that we could see increases in lead times. Now, Robert mentioned briefly just what we saw before in terms of the incredible increase in unit shipments in semiconductors. And if we look at this, we can look at the growth both on a global basis. I'm just going to look at globally. We don't have time to go over Americas, but we saw that from the start of the recovery, discretes grew by nearly 36%, analog ICs nearly 50%, logic ICs over 60% increase in terms of unit shipments. If you think about semiconductor capacity, semiconductor manufacturing, that is frankly just almost miraculous in my mind, that we were able to achieve that kind of growth in the semiconductor industry shipments. That is just mind-blowing to me when I look at that and you consider that. Now, that also leads me to an interesting conclusion that I've come to, which is that in recent years, we've actually hit a different growth path for the semiconductor industry. For many years following 2000, we were at about a 5.5% growth path up through 2015, 2016. But if you look at where we've gone as an industry, again, topping out at over $556 billion, we see that clearly now for many years, we are on a new growth path for the semiconductor industry. So when we looked at how long would it take to get to $1 trillion, well, before, we would look at mid, 2035-ish type time frame if we continued at a 5.5% growth. But the new path that we're on would seem to point to a much earlier trend towards that $1 trillion level that people like to talk about. So very different in terms of the growth. The incredible upward swing that we've seen is notable. Now, if we look at the supply chain health overall, Lehigh University publishes their risk index for the supply chain. Last quarter, transportation issues were the #1 concern related to the supply chain. Economic risks, however, have leapt up significantly to now become the greatest concern related to the supply chain, followed now by transportation and by supplier risks here. And then another major jump coming up in the cybersecurity and the data risks. So very notable in terms of what we see in terms of risks to the overall supply chain. Certainly semiconductors not immune from that. And so economic risks, and I think you have to point primarily to inflation and consumer confidence as key drivers of the concern about that economic risk. So this just shows how it's trended quarter to quarter over time in this index, and you see very clearly this surge in concern about the economy. So won't go through all these economic data points. The results from Economic Views, this is published by National Association of Manufacturers, NAM, they see personal consumption expenditures up, but savings rate declining significantly, and consumer confidence down dramatically at the University of Michigan, more mixed with the Conference Board. On the other hand, in the near term, the PMI index from IHS Markit, very strong optimism in February, rebounded very nicely. The economy in 2021 soared up to 5.7% growth in GDP. Forecast for 2022 is for 3.8% growth, although they do expect it to be slower in the first quarter of the year. But we have to come back to inflation. I'll wrap up with some comments on that. The Fed, back in their beige book with their commentary on the economy, earlier in the year, this is a point of great concern where they talk about the threat of stagflation, a period of accelerating price hikes accompanied by low growth. The downshift in the economy that we saw starting after the midpoint of the year. And the inflation is notable. As has been reported in many headlines, we've hit a 40-year high in terms of inflation rate, hitting 7.5%. But I show the longer history here to show that it could be worse. If we go back to the era of the 70s and 80s, we saw extended periods of extremely high inflation. And so while we said that inflation would be transitory, I don't think that that can be taken for granted. We do have a serious issue with inflation, and we see the growing trend in terms of the consumer price index led by energy. And certainly now, again, the events of the past week or so really do not bode well for what will take place with energy prices. Now, raw material prices have been going up, but if we look at this growth overall for semiconductors, this growth is a combination of real growth plus inflation. If we look at the revenues for semiconductors and we calculate it both in current nominal terms and also in constant 1977 revenue valuation terms, 77% of the valuation of our semiconductor industry, the growth came from inflation. So you cannot ignore inflation if you look at what's taking place in the semiconductor industry. we don't have time to go into this, but there is definitely a phase shifted relationship between inflationary pressures, growth in the economy, and also growth in semiconductor revenues. We see that once inflation reaches a certain level, that triggers a downturn that always follows. And so we have to watch out for that looking forward. So while we might see that, yes, we see a 7.5% to 8% growth outlook for this year, if we add in the factor of inflation, I think we do look at more likely a 15% range that Andrea was talking about in his forecast outlook. So with that, I'll wrap it up and hand it off to John.
Thank you, Dale, for that great presentation. John, when you're ready.
Perfect. Can you hear me there, Robert? Okay.
Yes, I can.
Yeah, if you don't mind bringing up our presentation, that'd be helpful. As Robert's doing that, I just want to thank everyone for the opportunity. I always appreciate being able to speak in these venues. It's not great to go last after two really good presentations. So hopefully my report won't be too repetitive and will bring up some incremental things to think about as we transition to Q&A. But I titled my report, Don't Be Encumbered by History, which was a flagrant plagiarist move from Robert Noyce's famous saying, don't be encumbered by history, just go out and do something wonderful. And it was the title of our Outlook piece for the semiconductor industry back in early January for this year. And I thought it best kind of captured the key message this morning, which is, despite our view that we think cyclical tailwinds need to dissipate and are likely going to dissipate in the second half of this year into calendar year 23, and I'll talk about that in my presentation, the structural foundation for this industry couldn't be better. And it's our view, and has been our view for a while, that semis are in the early innings of regaining value relative to the global economy. And as they do that, you're going to see accelerating growth rates. Dale touched a little bit about that in his presentation. I'll try to bring more light to that in mine. Robert, if you could go to just the key message slide. Kind of under the view that I should tell you what we're going to say before I say it. Here's kind of a summary of our key message today. One is our growth rate for semis for this year is about in line with Andrea's first presentation of about 16%. What I'm really going to stress in my presentation is something that we really haven't seen in semis for a very long time, and that's pricing power and pricing leverage, which actually accelerates year over year as you go into calendar year 22. Now, that said, what I do worry about is the Capex response upturn to date does increase the risk of accelerating supply growth as you go into the back half of this year, and that accelerating supply growth is always what precipitates sort of an inventory correction. So it's something we need to be mindful of. And that's really driving our base case for calendar year 23, which is our view that we're going to see a modest sort of mid to high single digit year over year decline in semiconductor revenue. The first half of that being kind of more of a unit correction, the second half being more of an ASP correction. But the important point that I want to highlight in the presentation today is that when you think about all the mitigating variables to our cyclical call, it's more likely that the cycle peak gets pushed out than pulled in. And I'll talk a little bit about that. More importantly, in the last couple of slides, I'll touch upon our secular view, which is the semiconductor revenue CAGR is moving from what has been about 3 to 5% to what we see is at least 6 to 8 and more likely upside to 9 to 12. Semis are still the most levered sort of commodity on the planet to the data economy, and the implications of AI, ML are still woefully under modeled in most semi revenue forecasts. And that just leads to my last point. For people in the audience that are in the industry, you're well aware that semi stocks have done extremely well over a 3, 5, and 10-year basis. The key point that we're trying to make is we still think we're only about midstream for semis revaluing higher. And I'll touch upon that in the last slide of my presentation. If you could just move forward to the next slide. This just really hits upon our expectations for calendar year 22 semiconductor revenue growth. Our view is that after a very strong calendar year 21, we see semi revenue up about 16%. Coming into the year, the consensus number was closer to 8 to 10. What's really driving kind of our forecast is in the lower right quadrant of this chart, which is semiconductor ASPs, which we think actually sees accelerating growth this year. In fact, one of the things we highlighted in our outlook report in early January is that if you just look at sort of the exit rate of semi ASPs from Q4 of last year and hold that flat, you get 7% ASP growth for calendar year 2022, which against no volume growth would already get you about in line with street consensus estimates for revenue growth this year. And quite frankly, all of our checks would suggest ASPs still have an upward bias at least through the first half of the year, which is really what's grounding our view that this year's revenue growth is going to be at least in that mid-teens level. If you could move forward, Robert. That said, we do worry about cyclical tailwinds slowing by the time you get to the second half of this year. Some of these charts I think Andreas showed, but the lower left of this is just kind of our summary chart of what a typical upturn looks like for semis. I think the important point to highlight is that we are already in the 18 month of this semiconductor upturn. You know, the average and median has been about 19, albeit the longest has been about 30. And I do think there are elements of this cycle that we've been talking about for a while that argue for stronger for longer. And I'll hit a little bit upon that. We have our version of semiconductor units relative to trend line. You know, the best fit line that we've come up with is about an 8 to 8.5% CAGR, which is what you see on the upper right. You know, based upon that analysis, you know, the good news is we're just now getting slightly above trendline unit growth in the data that we look at. Typically, semiconductor units peak somewhere between 15 and 20% above trend, which I think really helps underscore the fact that momentum here in the first half of the year is still going to be like relatively strong. The big concern we have is on the lower right, and you know, for you know, I always try to keep things simple. There's two things that kill a semiconductor upturn: time and rising capex. And I think clearly when you look at the capex response we've seen over the last 12 to 18 months, it does make me worried that as we get into the middle of this year and those capex dollars start to become productive capacity, you will see supply growth accelerate. As supply growth begins to accelerate, you always run the risk that customers that have felt compelled to build inventory over the last 12 months kind of take their foot off the pedal, and that's what tends to drive these cyclical downturns. We don't see that happening this year, but we think it's going to be prevalent next year, and hence our down year for calendar year 2023 semiconductor revenue. Next page there, Robert. Now, when you look at that, you know, we have a decline next year of about 5.3%. Again, the basis for that is a unit decline in the first half of the year, ASPs beginning to decline into the second half of the year. You know, one of the interesting things on this chart that underscores our belief in ASPs this year is that if you look at the calendar year 21 semi ASP trends by quarter and compare that to 23, what you notice is we don't have any quarter this year that's above Q4 of last year. I think that continues to provide upside for this year, but it does provide potentially downside as we move into calendar year 2023. Now, if you move forward to the next slide. As I said in my opening remarks, I do think that there are elements, mitigating factors that are likely to lengthen and push out the peak as opposed to pull in the peak. I've kind of highlighted three here. The first on the lower left is something that Andreas talked about, and this is just this idea of the supply chain moving from just in time to just in case. What you're looking at on this chart is basically semiconductor inventory as a percent of the total inventory supply chain that we look at. And what you notice from the tech bubble up until the financial crisis, and then after the financial crisis until now, is that there's been an upward trend where semis have been forced to carry much more of the overall inventory burden of the supply chain. And that actually makes sense. I mean, if you think about the two reasons why an end customer might want to build inventory, it's future expectation that they can't get what they want, and or future expectation that what they want is going to cost them more if they wait. And if you look during this period from really the tech bubble bursting until probably 2017, 2018, the semi industry was awash with supply, and pricing really only had a downward trajectory. And in that sort of environment, the rational thing for end customers to do was to push the inventory back onto semis, which they did. We're now in an environment where supply growth is structurally slowing, and we think ASPs have a structural upward bias. And in that environment, it's in the best interest of the customer to actually build inventory. And it's that inventory build that distorts real demand. And the risk is the semi industry always builds capacity to a demand curve that's being distorted by inventory. And by the time we figure out that a certain percentage of the demand curve was just being bolstered by inventory, we've already put that capacity in place. Hence, we create periods of oversupply and bad pricing. That said, I do think in this current environment, the new normal is that the supply chain is going to have to take on more of the inventory burden over time. It's unclear to me, whether or not semis go back to sort of that mid-teens level or low 20% level. But the more that the customer holds inventory, the longer and stronger this upturn will be. But it does create a bigger hangover when things do come to an end. The second chart on the upper right, I think, is an important one to highlight, because I think one of the reasons why we've been in a stronger for longer cyclical upturn has really been all of the consolidation that's happened in the semi space over the last 10 years. There's been 250 mergers and acquisitions in semis. There's been very few new company formations in the space. And as company A bought company B, the first thing they did was rationalize capacity. And so I think one of the things that people probably missed early on in this upturn is typically at the bottom of the cycle, as end customers are depleting inventory, semi companies are forced to underutilize their facilities, such that at the bottom of the cycle, there's sort of this reservoir of underutilized capacity, which is relatively easy supply growth. The problem with this time around, with all the consolidation, we didn't have that reservoir of underutilized capacity. And typically, if it takes 3 to 4 months to re-ramp a fab, and it takes 12 to 18 months to 24 months to actually build a brand new fab, this upturn is much more dependent upon new fab creation to drive supply growth, which is, I think, one of the reasons why we've had this stronger for longer cyclical upturn. And then the last point I'll make is just the strategic one, and that is, thankfully, world governments, I think, have figured out something that everyone in this webinar has known for a while. Semis are probably, if not the most important, one of the most important commodities on the planet. And it's a strategic imperative now to secure domestic production of semis. The chart you see here is just the breakdown of domestic production of semiconductors by geo over time. And clearly you now have world governments that are willing to subsidize and incentivize domestic production. Now, while I think this is a long-term, very positive dynamic for the industry, my biggest concern is whether or not the industry uses subsidies independent about where we are in the cycle. The last thing you want this industry to do is to be building capacity as their customers are going through some sort of inventory correction. My hope is a lot of the Capex plans that Andreas talked about are always flexible relative to demand variances. And my hope is that if we get into 23 and it becomes apparent that end customers are going through some sort of inventory correction, we will see some sort of push out in the capital spending plans by the industry. Andreas, Robert, if you could go to the next one. With all of that cyclical caution in place, I do really want to highlight our structural view, which is still extremely positive. One of the things that we've been arguing is something that actually Dale took a look at in some of his charts. And that is, if you look at semiconductor revenue as a percent of global nominal GDP over time, from the beginning of semi time until the late 90s, semis consistently outgrew global nominal GDP. Since the late 90s, we've actually been consistently undergrowing global nominal GDP. That occurred really up until 2016, 2017. And the interesting thing is, if you look at the peak in the late 90s to where we troughed in 2016, 17, we're down by like 25 to 30%. And the question really begs, what happened? And we've got a lot of written research on this, happy to share it to anybody who wants to reach out. But in our view, really 3 things happened in the late 90s that then began to reverse kind of in the 2008 time period. And that is, in the late 90s, barriers to entry in this industry came down. The biggest driver of that was the advent of the fabless model and TSMC in Taiwan. All of a sudden, the Capex barrier to entry was taken away, and you saw significant new company formation around the fabless semiconductor space. In addition, supply growth began to accelerate. Not only did Moore's law cadence increase, it was also the period of time where the industry moved to 300 millimeter wafers. And in hindsight, that was way too much capacity, way too quickly. And then the last thing that happened in the late 90s is the end demand became much more consumerized, where entry price was the determining factor, not total cost of ownership. And you layer that all together, and what really happened in the late 90s that was different is that average selling prices for semis from the late 60s to the late 90s went up pretty consistently, about 3 to 5% every year. In the face of these three issues, ASP started to deteriorate to the tune of 3 to 5% declines from the late 90s until about 2015, 2016. The good news is all three of these things are now reversing. Barriers to entry are going up. The biggest driver for that is R&D is now at least as big a burden as Capex. And even if you're fabless, you need big R&D budgets to support the move down Moore's law, to support the ecosystem. And as a result, we've seen a lot of M&A in the space, which I highlighted earlier. Secondly, without the move to 450 millimeter, supply growth is structurally slowing. And that is a good thing in our mind. One of the things that I don't think gets discussed enough is we are arguably in the worst supply environment in the history of the semi industry during a 5-year period of time where wafer fab equipment sales have gone up by almost 150%. That to me is the clearest indication that the cost of capacity is actually increasing. And that helps to put, I think, a lid on what ASPs need to do in order for semiconductors to generate an acceptable rate of return for the investments that they need to make. And then lastly, with the mobile handset revolution now behind us, everybody who can afford a phone owns a phone. We've seen very good new demand drivers emerge in the non-consumer space, whether that's places like autos or infrastructure or data center. And actually with the acceleration of AI and ML, we think that becomes a very strong driver of future semiconductor demand. One of the things we talk about kind of in our data paradigm thesis is this idea that when you think of data, you've got to think about it along 4 lines. We've got to create the stuff, we've got to store it somewhere, we've got to move it across a network, and then we've got to analyze it. There's one argument to be made that the analytics bucket is the most important, because if you can't analyze data, you can't monetize it. And if you can't monetize it, it's not all that interesting. Albeit as soon as you can, all of a sudden data becomes so interesting that you're willing to subsidize the other 3 buckets. One of the things that we've been highlighting in our work, and I still think is underappreciated, those first 3 buckets of create, store, and transmit have all benefited from non-linear cost declines over time during the digital age. Moore's law tells you every year it's cheaper to make a bit. There's a Moore's law equivalent in storage called Kreider's law, and there's one in networking called Butter's law. And our argument's fairly simple. The way the technology ecosystem works in our mind is there's a part of the ecosystem that focuses on bringing down the cost of doing something. And as that occurs, there's another part of the ecosystem that comes up with brand new use cases for that declining cost curve. My favorite example to talk about, because it's a little bit counterintuitive, is the move from 3G to 4G in the infrastructure market. As you dramatically reduce the cost of moving data, all of a sudden companies like Uber and Lyft, which weren't economically viable in a 3G world, became economically viable in a 4G world. And so what happens as you can bring down the cost of doing something, the new application growth always grows the market to be significantly larger than people ever thought out of at its inception. The exception to this sort of rule has been in analytics. The cost of analyzing data during the digital age has mostly only ever gone up. The reason behind that is the vast majority of data the world creates is unstructured, messy data, and you've got to clean it up and structure it in order to get something out of it. And that's usually pretty timely and pretty costly. It's the reason why data has been growing at a 50% CAGR for over 20 years, and yet 98+% of the data the world creates still sits dark. This is where I think AI and ML become critically important, because in our view, it's the first technology that promises to systematically bring down the cost of analytics. And like other buckets, as that cost curve comes down, the leap of faith that we're willing to make is that people will come up with brand new applications that will grow the market to be significantly larger than people ever thought at inception. Clearly the two semi markets that are most levered to that would be compute and memory. And what we've written about on the compute side is this is a market that has historically grown at a 3 to 5% CAGR. We now believe, in the AI ML world, 15 to 20% CAGR is likely the new norm. One way to think about it is we've got a volume of compute today that's focused on that can only analyze 2% of the data the world creates. How much more compute do we need if 2 goes to 4, goes to 8, goes to 16? And it really underpins our view that Dale talked about in his presentation. We are on track to at least $1 trillion of revenue by the end of the decade in the semi industry. That would only be a 6% CAGR from here. And remember, our base case is 3 to 5 is going to at least 6 to 8, if not 9 to 12. And that's a pretty impressive thing to accomplish if the industry can. I mean, one way to think about it, it took 50 years for the semi industry to eclipse $500 billion of revenue. Many models are now predicting the next 500 is going to come in an 8-year period. And I think it actually is one of the biggest challenges for the industry. How do you create organizations that have the capacity and scale to support that future growth, but still have the flexibility during periods of cyclical corrections to maintain profitability at levels that this industry demands in order to reinvest? And to me, and the people in the audience, to me, that's the number one sort of challenge for the industry today. Robert, I'll end my presentation on the last slide and then give us time for some Q&A, which is really just our view that semis are still very early in recapturing value. Lower left chart is that chart that I referenced to earlier, semi revenue as a percent of global nominal GDP over time. The most important thing that I would argue is that while semi stocks have been big outperformers over a 3, 5, 10-year period, if you kind of look at semis as a percent of global market capitalization, which is what we do in the lower right chart, semis value to the global economy peaked in 2000 when semis were about 4% of global market capitalization. It troughed in calendar year 15 at about 1.5. We're sitting at about 3.5% today. Our models suggest there's no reason why we can't get to 6 to 8 out to 2030. Put that in perspective. That's sort of where energy is sitting today. And I would argue that semis, are at least as important to energy in a world that's moving towards a truly data-driven economy. And so while we do have some cyclical concerns as we move into the back half of this year and calendar year 2023, the long-term prospects for the industry are still extremely bright. And with that, Robert, I'll turn things back over to you to moderate questions. Robert, I think you might be on mute.
Thank you. Thanks for that great presentation. We have some time to have a Q&A. I would tell the audience to please use the Q&A tab to ask questions and not the chat tab. And just to get things going, I do have one question. So in order to meet the current high demand for semiconductors in the short term, firms have increased their fab utilization to over 90% in 2021. And for the mid to long term, firms have committed to building new capacity throughout different regions. And you all did touch upon this. And I'm just wondering, given this information, do you all see potential for a glut in the industry in the near to midterm moving forward?
I guess maybe I could share a couple of thoughts on that. In a cycle, you always have over and under capacity. The question I would say of going to the term glut, that indicates in my mind something that's a dramatic downward impact. And given the shift in inventory management, as we've talked about from just in time to just in case, yes, at some point there will be a correction, but I don't see it being a glut. In fact, what I see it is just as in inventory, you pay a certain price for securing your products. For many years, we've been talking about the need to reshore, onshore, whatever, for supply chains. And if you go back and look at the chart that Andrea shared, you see the incredible amount of investment that's taking place in the United States. And what I see is taking place is companies are having to look at establishing a more reliable supply chain that is not as dependent on Asia as it currently is. And so I believe we're in the process. So there may be some points where we have difficulties with oversupply, but I think it's going to be worth it as we gain a more stable, more secure supply chain. We talk about the concerns about Ukraine and Russia right now. The nightmare I've talked about for a long time now, is if China now uses this as a pretext to move on Taiwan, the problems with Ukraine and Russia will be a faint memory of the past, given what will our concerns will be in the semiconductor industry if Taiwan comes into play.
Great, thanks, Dale. Does anyone else want to comment on that? We're at the top of the hour now. I think we have time for maybe one more question or one more comment on this specific question.
Well, Robert, what I would say, Robert, is it does bother me. I mean, listen, I think the variability of a cycle is really driven by how much inventory end customers accumulate while semis think it's real demand. And so I do worry about cyclicality becoming more pronounced going forward than it has been in an environment where end customers weren't incentivized to build inventory. That said, I agree 100% with Dale's comments. We've gone through 20 years of globalization of supply chains, which in our view was really a catalyst to move value from the back of the supply chain forward. Ultimately, the biggest beneficiary being the consumer with low prices. In a world where globalization slows or reverses and supply chains become a little bit more sovereign and a little bit more redundant, I think it's a catalyst actually for value to migrate backwards in the supply chain. The critical question becomes, how much pain can the consumer and the end consumer actually take before they start to push back? I think there's a swinging back of the pendulum that we're still only midstream with semis capturing incremental value because of this reversal in globalization.
Yeah, one more thing I was going to add also, which I think I tried to show in the charts, is that if you look at the spending mix, right, you'll see that most of these big dollars are being spent in the logic and foundry spaces, which is, you know, sort of a new thing, right? Because typically it was memory that used to spend quite a bit. And this time around, actually, the memory spending seems quite rational. And I do think that with this localization that we're going to see in the supply chain, there's going to be more inefficiency, right? So even though they are spending more money, it's not going to buy you the same amount of wafers. We also have increasing capital intensity, especially the leading edge, right? So again, you know, there is a lot of money, but at the end of the day, it's buying the same capacity as it did back in the day. And one more thing I was going to point out is that if you look at it and see who's managing this new capacity that's coming online, it's primarily logic, you know, advanced logic suppliers and foundries, which they need to have a customer to put that capacity in place, right? Or at least have some idea, instead of in the memory case, you just build and then you hope that you'll clear up at some price point. For the foundries and advanced logic suppliers, they need to have some sort of idea and order before they put all the capacity up running. So in a way, I don't think we're going to have the sort of hangover they used to have back in the day when the memory manufacturers went on a, you know, spending spree. So from that perspective, I do think that we might have some overhang at some point, but I'll be very, very surprised if it turns into a glut like we've seen, you know, in the previous downturns.
Great, thank you, Andrea. Great answers to these questions. We are at the top of the hour. I want to thank Andrea, Dale, and John for participating in this webinar today. I would also like the audience to know that a recording of this webinar will be on SIA's website for you to view at another time. And with that, we'll end this webinar. Thank you.
Thank you.
Thank you.
Thank you.